Right.
And Carlos, tell me when I can start. So
There already we have 69 guests, so they're coming in slowly. I would say give it a couple minutes so people come in and then.
I see the number of participants. Yeah, 92, 96, 100. Okay, so I guess we'll wait maybe 30 seconds until everybody logs in and we can start.
No problem. I was actually getting a delivery, so I apologize.
Okay, so I guess we can start. So thank you everybody for joining us today. For those that don't know me, my name is Eli Bracha. I'm the director of the Hall School of Real Estate at Florida International University. I'm also a professor at the program. I'm teaching different courses, including real estate investments, which is my specialty. And I'm very proud that our school, we just recognized for the third year in a row that we're #1 in the United States and #2 in the world in real estate research productivity. We also recently were awarded RICS designation, and I believe that we're the only school in the world that has 3 of the most prestigious professional organization accreditation, which is the RICS accreditation, the Appraisal Institute, and the CCIM. It didn't come easy, but those 3 organizations recognize our quality, and we're very happy for that. And for those people that may be listening to us and don't know, we do offer a master's degree in real estate. It's 10 months or 12 months master's degree. It's geared toward real estate professionals or professional adults in general. It's offered either online or in face-to-face mode. Right now, we're not in face-to-face mode, but hopefully starting in the fall, we're going to be back in face-to-face mode. So those of you that are listening and maybe interested in getting some information about the program and maybe joining us, you can contact Federico Abreu. And I think Federico is going to put his email address on the chat, so you can contact him if you want to get some more information. So this is a little bit about myself, our program, and I would like to start by telling you about what we're going to do today and introduce our panel discussants. So basically, we're going to hold a virtual panel discussion. It's going to be, the topic that we title is the state of real estate amid COVID-19 from developers' perspective. So we have 3 distinguished developers with national experience and recognition, but local base and exposure. So I would like to introduce them, and I guess we'll do it alphabetically, I guess by the last name. So the first panelist we have is Mr. Victor Ballestas. Victor Ballestas is the principal of Integra Investments. He's focused on managing and enhancing the company's business development structure and marketing campaigns. Mr. Ballestas began his real estate career at WSI Communities. I believe that's where he met Mr. Purcell. He was a division manager at Willock Street Capital, which is a private equity investment fund, and served as the regional director for FT Residential, which is a subsidiary of Starwood Capital. After the 2009 financial crisis, Mr. Ballestas was named a power leader by the South Florida Business Journal. He holds a bachelor's degree in finance from Florida International University. Of course, that's why he went so far, and a master's degree in real estate finance from University of Florida. And I believe that's before we offered our program, of course. That's why he didn't come to us. So that's Mr. Ballestas, and thank you for joining us. Second in line alphabetically is Mr. Anthony Burns, and he is the co-president of Plaza Equity Partners, which is a real estate development and finance company that is based here in Miami. Plaza Equity Partners focuses on large-scale, impactful developments and is the managing partner of Magic City Innovation District in Little Haiti, which I'm sure many of you are familiar with. Prior to co-founding Plaza, Mr. Burns served as a senior vice president of investment at iStar Financials, which I believe that's where he met Victor Balestas. They worked together on a few deals, which is a New York-based real estate investment trust. Mr. Burns served in the United States Army. He holds a bachelor's degree in environmental engineering from the United States Military Academy and an MBA from Harvard Business School with concentration in real estate finance. So thank you, Mr. Burns, for joining us. And last, but of course not least, we have Mr. Diego Purcell. So Mr. Purcell is principal and co-founder of Global City. Prior to founding Global City, he served as a director of Terra Group, which is one of the largest real estate developers in South Florida. He also led projects at WCI Communities and Codina Partners. Mr. Purcell has provided real estate advisory services, including mergers, acquisitions, dispositions, and asset management for major institutions. He was also responsible for creating the first real estate fund in Ecuador with Banco Popular. Mr. Purcell served in the United States military. He holds a master's degree in strategic management from University of California and bachelor's degree in architectural engineering from University of Texas. So thank you, Mr. Purcell, for joining us. Okay, so like I said, we're going to be starting with some questions that I have ready for you. Some of them I will address all of you because I know that you have different answers, very different answers. So I'll let all of you address them. And some of them maybe I'll have one or two of you address them. And if the other one or two want to jump in and talk, please feel free. At the end, we're going to have our students asking Q&A. So I'm asking anybody who is watching us and would like to ask a question, please do not put them on the chat, put them on the Q&A. Carlos and Federico will collect those Q&A and we'll ask the participants or the panelists around 12:10 when we start wrapping up. So let me begin with kicking off this conversation by simply asking each one of you what kind of development projects you have in your pipeline at this point in time, either project that you recently finished or those that you are working on currently. So Victor, maybe we'll start with you.
Sure. So I think the two most notable projects that we finished recently are a big mixed-use project in Aventura called Aventura Park Square. It's a 1.2 million square foot, what we call true mixed-use project. You know, Ellie, of course, you and some of the students have been able to see it. But what we did there is within an 8-acre parcel in Aventura, we developed 5 buildings all at the same time. And that's inclusive of a hotel, 170-room hotel, which is now an A-loft. It has about 100,000 square feet of Class A office, 131 residential units, a 150-bed ALF, 50,000 square feet of retail. So 6 different uses in, within 8 acres. It's a very walkable project. It's pretty much up and running right now, except for the fact that the retail is pretty much closed down because of what's going on in the market today. So we finished that one about a year and a half ago. It's fully stabilized. Another one that we recently finished was a 358 unit rental project called Hollandale Art Square. And that's pretty much stabilized. We're about 92% occupancy. We've closed on a Freddie Mac loan recently on that project, so it's refinanced. So projects currently in the works, we have 2 tax credit affordable deals that we are now breaking ground on. One in Alapata and another one in another market called Brownsville. Those average about 120 units each. We have a large workforce project in Key West that we're about to break ground on also, which is around 218 units. We are a developer for hire on the Starwood Capitol office building in Miami Beach, which is about 140,000 square feet of Class A office. We have another small office building on Lincoln Road. And that's about it.
That's more than enough. It sounds like you're very busy. Wow, impressive. Mr. Purcell, do you want to tell us what is in your pipeline or what you just finished working on?
Yeah, sure. We're about to deliver 1,240 bed student housing project directly across the street from FIU. We issued a private activity bond last year to finance it. It was a pretty interesting financial move. So it was $237 million. And so we are on time. We became on budget. So it's going really well. And then next door to it, we also acquired another property where we have a joint venture with Toll Brothers. We're going to do another 1,000 student housing beds. And we are also doing 248 units on Biscayne Boulevard. It's pretty interesting because it used to be an American Legion site. So we did a long-term lease and they got very well rewarded. And we're also building a brand new American Legion facility for the veterans, which they have been completely ignored in the last years. So this is the first effort by a private enterprise to do this. So we're going to be finishing that one in September. So that's 248 units, and then we have another 250 units, a lot just west of it. We're going to start probably in the next spring. And then we have a big effort doing single-family home for rents in the Sun Belt, as far as west of Texas and as far as north as Washington, D.C. And we're very excited. The prospects look amazing. We already started in Nashville. We started in North Carolina. And we're about to start break ground in Austin as well. So that keeps us, that's enough for us.
Okay, also very impressive. Anthony, do you want to tell us what you're working on?
Sure, thank you. Good morning. The last large project we completed was Marina Palms Residence and Yacht Club located in North Miami Beach, just south of Aventura. It was two 25-story towers, 268 units per tower with 112 slip, a large luxury marina. We started that project in 13, ended up completely selling it out in 17. In 17, we moved on to the Magic City Innovation District, which is the current project we're dedicating most of our time to. Magic City Innovation District is located in Little Haiti neighborhood. We recently completed the re-entitlement efforts after about 2.5 years, where we took essentially a dilapidated trailer park along with several sites that had old warehouse. We fixed the warehouses up. It's about 200,000 square feet of adaptive reuse for re-tenanting and placemaking. And then with the upzoning that was achieved in June, the site went from a maximum development capacity of about 4 million square feet with 5 to 7 stories to 8 million square feet with 25-story high-rise zoning that can accommodate about 2,650 multifamily units, 1.9 million square feet of office, 432 hotel keys, and about 500,000 square feet of retail. So it's a large project that will take place over the next 10 to 15 years, and we're in the initial planning process for the first multi-story or multifamily and office tower.
Okay, so it sounds like 3 of our panelists are very busy working on multiple projects, very large projects, and very different. So let me start with asking you something a little bit, and we'll continue with you, I guess, Mr. Burns, something that is more related to the current situations. If you can tell us a little bit about the kind of difficulties that are directly related to your development process that you're currently facing because of the COVID-19 situation. So things like disruption in labor, materials, delays in permits, anything else you can think of. And I will ask later, either Diego or Victor to address the same one, but if you can tell us the kind of difficulties you're facing now.
Sure, I'll take a first crack
Victor,
at
you wanna
this.
start?
Obviously, the current situation has impacted every single aspect of our business. Most notably, it's impacted with our current tenants. Our current tenant base is a mix of mostly office and retail. Our retail tenants, being gallery, art galleries, etc., also have a number of marketing and digital tech companies. All of those companies have suffered various setbacks in their own businesses, and we've been actively working to discuss what concessions can be made in rent. I will tell you that for the month of April and May now, we've collected 100% of our rent from our tenants. So that has not been an easy task, and it's required us to be flexible and work with tenants on an individual basis. The other large impact is in the financing markets. I would say that whether it's debt capital markets or equity capital markets are effectively closed right now, other than for distressed deals, at least in the development space. And so, any money partner is essentially looking to come in at a substantial discount to a developer's basis and make some type of very opportunistic buy-in. And so I think until the knife, the knife continues to fall a little farther and people have a little bit of certainty on what end they're going to grab, that's going to be the current state of the state of the financial markets and future investors. And so I could go on more, but I'm sure the other panelists have also things that they can add.
Victor, do you want to address that?
Sure. And I agree with Anthony. I think it's pretty much impacted everything. I mean, I can probably start in what I think it's impacted the most, which is probably our retail tenants. I had a conversation with Anthony last week, and I actually offered to hire him to run my management because we haven't had as much luck in collecting from our retail tenants as he has. In Aventura Park Square, we have 50,000 square feet, probably 18 tenants, and I think only 2 or 3 are current, because the rest have been impacted greatly. I mean, most of them are retail or fitness, and when the retail market was slowing up in general before COVID, we felt lucky because the restaurants and the fitness facilities were all doing very well. But I think it's probably the one, 2 of the ones that have been impacted the most through COVID, right? Because nobody's going to gyms and nobody's going to restaurants. So we've had a hard time with those retail tenants. That's probably impacted us the most. I would say kind of middle of the road is through the entitlement process, because we do have some projects that are going through the entitlement process, and getting meetings set up, getting community meetings set up, all that stuff has been, pretty impossible. So, of course, some cities are starting to adapt now and doing Zoom meetings and allowing us to actually do community Zoom meetings, which has been helpful. But that's still slowing down the process pretty significantly. I would say that's kind of middle of the road impact. And then I think the ones that have been impacted the least is probably our construction sites. Although we've had to make some changes on the construction sites with some signage, some social distancing and stuff like that. And we have had some impact from some materials that come from either Spain or Italy. Our construction projects have continued, and we think we've done a pretty good job of keeping the schedule on track. So I would say that that's more of a minimal impact. So, it's kind of all across the board.
Okay, thank you. And Diego, maybe you can address a little bit from the pre-leasing side? I know, especially on your student housing, now with the question mark of whether students are coming back on campuses in the fall or not, and if they do, to what extent? Can you tell us how it's
for us, that's a big question. Landmark, he's our property manager. They're doing a pretty amazing job. We're already 60% leased, which is pretty, it's very high. We believe that the schools will be open in the fall. We are under budget, on time. Coastal Construction is doing a great job for us. So, you know, it's just things you cannot control. And it's going to be either open or not. But the project it's going really well. And like Victor was saying, there's some costs associated with in construction. Thank God we're not slowed down or anything, but just the cleanup costs and things like that have really, it's expensive. You know, you're talking about, you know, $20,000, $30,000 a month of additional costs that were not, you know, programmed. But on the other hand, you know, it's people's lives, so you gotta do what you gotta do.
Okay, well, maybe we'll continue with you, Diego. Can you maybe tell us about the kind of jobs or tasks that you're currently completing from home or from the office that usually you completed face-to-face? So I know obviously that, you know, we all, or you, three of you are in the business of construction development that clearly cannot be done from the office. So can you maybe—
No, we've learned to all of us. I mean, I talk to Victor on a weekly basis. We've learned to have to do it via this way, because so that's going to change. The office market is going to be seriously impacted, for sure. We took additional space in my office building, which now I'm starting to regret. But we've been able to manage everything remotely, and if construction does not get stopped, and you can manage pretty much everything remotely. We have learned that. I mean, that's been a learning curve.
So basically, aside from the construction side, managing everything from the office?
Yeah. No, I still go to the construction site at least once a week and things like that, but it's different than what it used to be. I mean, you have to learn new ways.
Anthony,
I don't know what you guys feel.
Anthony, anything that you do differently, things that you do now from home or from the office that before you did face-to-face?
Well, certainly it's cut down on the amount of time I've spent at our projects. So I'm more in the visiting, trying to make the most of a single visit a week, just to cut down on my time out. But for one, I'm looking forward to getting back into the office. I think Zoom is a tool, but for our company, we are going to be back to a company that has meetings and where you can be in the same room as people and you can communicate. So while I view this as a temporary thing, and Zoom will certainly, in these type of teleconferences, will be a tool in our kit bag, our company is going to go back to an in-person office as soon as we can, just because I think there's a certain element of cross collaboration information that's lost in this process.
But do you see, Anthony, maybe any of the new habits that maybe you acquired over the last few weeks or a couple of months, any of them you think will actually stick around even when you are free to go back as much as you want to the sites and to the office? Do you think some of those habits will stick and make your work actually more efficient?
It's hard to say. I do think, you know, you're already starting to see, at least in the corporate America side, in terms of how they view office. You know, there's been this push to densify offices, and you see that in the co-working with hot desks and making corridors smaller and making, you know, people packed into office space. to create this cohabitation feel. I think that that is a trend that is certainly going to go away in the near term. And so, I think there'll be this trade-off of, firms actually wanting to use more office space for the clients, or for rather the employees that are going to be in the office. However, the counterbalancing effect to that will be that there will also be more people that I think do work from home on a regular basis. And so I see those are the two tensions that are going on. Employers are going to want to give their employees more space at the office, but there's going to be less employees at the office. And so where the net usage of actual square footage in office buildings shakes out, I couldn't tell you.
Okay.
That's very true. Yeah, I think it's affecting more the deal part of our business rather than the operational side of the business. Because, real estate deals are very large, and you do need to sit down with the person and look him in the eye, sign where things need to be signed, and agree things, and it's difficult to do it digitally. But operationally, I think we've all learned that it can be done.
Okay, so maybe Diego, maybe we can stay on the same topic. I'll ask you, and then I'll ask Victor next. So do you see any change or decrease in interest from investors who come into your new ventures?
Yeah, it's very difficult to communicate with with somebody who's not on the day-to-day on the business. So yeah, I do see, but on the other hand, things are starting to slow down and things are starting to become more normal. But yeah, that definitely affected, because investors take a step back, and at the end of the day, when you do a deal, is based on who is the sponsor, and it's very hard to judge that from far away.
Okay, and when you do deals, or maybe when you have conversation with investors now, what kind of returns are they asking for the type of projects that you're working on? And are they different than what they did maybe ask for 2 months ago?
It depends geographically a lot. It depends where they're from. So, but we always offered in our deals, people make some very high returns. So that has not been an issue. I don't know, Victor, maybe you can.
Yeah,
we do
sure.
pretty much the same thing.
Yeah, I mean, Ellie, from our perspective, there's a lot of moving variables right now, which we're trying to kind of nail down. I mean, we are getting calls from investors that are interested in getting in that we hadn't gotten before, because they thought that the market, 3 or 4 months ago was a little heated. Today, it's a little bit more opportunistic. So, we have investors that we haven't heard from a while saying, hey, we know that there's going to be opportunities in the market. So, keep us in mind. We want to get in. But, that's a positive. But then there's a lot of sort of negatives now, right? Which is that, like Anthony said, the capital markets are pretty much frozen. So if I was going to go buy something today and I had to close quickly, I'd probably have to do it without financing, which is impactful to returns, of course. And then, there's just the bid-ask spread is pretty much wide now. I mean, a lot of people are thinking that you need to buy things in distress today. So their bid is going to be low, and I don't think that that's trickled yet into pricing, except for a couple circumstances that I've seen recently where maybe their loan is due and they know they're not going to be refinancing it. So they've gotten a little bit more realistic on what price they need to sell at. But aside from that, the banks are working with everybody today. So I think most people will have time and don't want to kind of drop their prices on deals right away. They want to hold on as long as possible, because generally, I think that's what everybody learned in the last recession, right? Hold on as long as you can, and if you hold on long enough, you might get out. There are a lot of variables that we're trying to nail down in the market today to see how this plays out.
I see. No, that's interesting, and maybe I'll ask you, Anthony, because I did see an article or a recent interview with Sam Zell, and he was saying the same thing that Victor was saying, that a lot of the sellers are still trying to get the same prices, especially on the office and retail. A lot of the sellers are still trying to get the same prices that they would have received maybe 2 months ago, and then the buyers want to get a deal. And because of that, the bid-ask spread is very wide, and basically no deals are being done unless those that are very distressed. Do you see it that way? And if so, where do you see the buyer and the sellers eventually meet? Or is it going to be somewhere in the middle or toward either one of those sides?
Well, just as an anecdotal story, I have a few friends that work for a few of the larger opportunity and private equity funds in New York. And in talking to them, and this is a week ago, their mentality is they're not even going to go to investment committee and present a deal to anyone unless the headline political answer is, we are stealing this. This is a huge opportunity. We're buying it at 50 cents on the dollar of 8 weeks ago. That type of, mentality is what's permeating at least a couple of these larger, name brand private equity funds that, they have a lot of trouble in their own portfolios. A lot of these companies obviously have legacy deals that they're dealing with. And so for them to deploy new capital, it has to go in and it just has to be brain dead. And so it's not necessarily they're looking at, well, we want to get a 20% IRR, and last month we were okay at a 17% IRR. It's, we're going to go in and we're buying this at 50 cents of what it was worth 8 weeks ago. And so that clearly is not a sustainable market. And I think once there's more stability in the macroeconomic circumstance, there's the economy started to open, there's not a second wave, there's a lowering of overall risk in the world, I think that mentality will start to crack a bit, and they'll say, okay, well, we're still open for business, we want to get good deals, let's start looking at where there are opportunities, but it doesn't have to have this headline of you're getting it at 50% off for you to come and present to investment committee. So I see there being more movement on the capital side, because I think sellers, between myself in this situation as a user of capital, banks are, as I think Diego said, banks are working with people. If you have a good project, yes, there's distress in the market, but it's not acute stress where we have to do something today or we're going to lose the project. People that have solid projects, they're going to have time, and I think at that point, as we get later and there's more macroeconomic certainty, the deals will start to normalize more. But until there's more certainty, I think people that are deploying capital are just gun shy about deploying new money into again, I use this analogy, the knife, the falling knife, they're going to grab the blade instead of the handle.
Interesting. And I think, Anthony, and I want to maybe see what you think about it, Diego. That's not so much on the development side, but more on the investment side. But what Anthony's saying, that on some of those deals, people asking now 50 cents on the dollar. Well, if you've been following public markets, so real estate investment trusts, especially on the retail side, and a lot of them also in the office, a lot of those are selling. Even when you add back the debt, a lot of them are selling cents on the dollar. So we know correctly that the public
markets, you have to have very long money to invest. At least on my side, that's not our type of business. No, I absolutely agree with you. The office and the retail market, of course, I mean, they're hurting quite badly. But to be able to get a good return, you need to think very long term.
So do you think that the private market will go toward the public prices or vice versa? In other words, public rates will go up in value to, to be selling at equal prices to what the private deals are, or the private deals are just lagging and eventually will come down to match those public prices?
I don't know. I mean, what do you guys have seen? I mean, I see the office rates going down, the retail rates absolutely completely going down. So it depends, I guess, from each individual situation, what kind of financing they have. But that's the first part. The residential market has not been affected as much as those two sectors, for sure.
Okay. Okay, Victor, maybe we'll continue with you.
Yeah.
So obviously, the last 8 weeks were very, for many people, made kind of it was an eye-opening event for whatever it is they've been doing before. And now, was this an eye-opening moment for you or for your firm? And did you, and when I say eye-opening moment, in a sense that, would you change anything that you've been doing before if you knew that this kind of situation would have happened, in terms of your attitude toward risk, financial leverage, operating leverage? Would you do anything differently? Or do you do now anything
Sure.
differently to prepare maybe for the next time that something like that comes around?
Yeah, so, I mean, we, about probably 2 years ago, started feeling the market being a little frothy, a lot of activity, but we thought, again, people were overpaying for things. We prepared ourselves for something, right? Because we knew something was going to happen. We knew there was going to be some type of a correction. So we shifted our business from what we usually do, with just Class A apartments, condominiums, high-end developments, over to what we're doing now, which is workforce, affordable, fee development. So we knew something was going to happen. We didn't exactly predict this. So we didn't think it was going to come this fast. So it was certainly an eye-opening event. Do we change our business now because of this? Yeah, I mean, there's going to be some changes. I don't know if you can, as a developer, say, oh, we're going to, start laying off of things because there may be another COVID event or something like that. I think we got to keep the machine going, especially since, we got 40-something people in the office now. But we will be more careful. I think, Diego's right that the impact today is mostly from what we see or the long-term impact that we think is going to happen is going to be in retail, office, and probably hotels. So I think that those are 3 areas that we'll probably stay away from in the near to medium term. I think when we develop a residential project, it was really easy before to throw 20 or 30,000 square feet of retail in there and just use that to juice the returns. I don't think we're going to be doing that much anymore, because 20 or 30,000 square feet of retail in a residential project is not going to be very easy to lease. And I think we'll probably stay away from the bigger office deals. Maybe we'll still get into some boutique office deals because we can tailor those to where the market is today. But I think the bigger office deals we'll probably stay away from until we see a little bit more clarity in the market.
Okay. Anthony, did you change your attitude toward risk, leverage, or any other kind of behavior?
To speak about leverage, I spent during the Great Recession, 2007 through 2009, I was working for a mortgage REIT that had significant exposure really across the country in development, high-rise condo, and with a particular exposure down here in South Florida. And that's actually why I ended up moving down here. And what I learned out of that as it pertains to large-scale development, any development cycle, especially in a boom-bust economy like South Florida, and if it's long-term, it'll have to ride over several development cycles, even at a national level, is that the people that get in trouble are the people that are over-leveraged. And while you can certainly it's a hit getting into a project when you have lower leverage because you can't market liquid equity returns. When you have a market, you have a black swan type of event like we've had now, or just a more typical recession. Those are the projects that end up failing and going back and having to get worked out, et cetera. Whereas projects that have lower leverage, those are the projects that survive to fight another day. And so, that luckily that was something that we had internalized before we got into the Magic City Innovation District. We're low leverage because we knew that, no one could forecast that we're going to have a pandemic, but you could certainly forecast that there will be significant downturns over the next 10 to 15 years in South Florida. It traditionally has happened and will happen again. And we were prepared for that. So from that standpoint, I would say we were well prepared, and we'll continue to manage our portfolio that way. But in terms of other changes, we're going to be evaluating. We're going to be evaluating what comes to us and making changes on a routine basis. I think, again, my high level view on this is we're in the early innings of this. This is not, you remember back to when subprime happened. Between the subprime crisis and when Bear Stearns and Lehman failed, it was over a year. And so we're in the early stages of what's going to happen as a result of this. We're still dealing with the acute trauma of the actual infection and getting people back to work, let alone the longer term implications of what's going to happen when you have this level of unemployment, defaults, et cetera. So our mentality is to be very conservative, to be liquid and be defensive because we're in the early innings.
Interesting. Diego, I know that you are usually structuring your deal in a very conservative way and very creative way with the bonds that you issued for one of your recent projects. Can you tell us how it affects you, if any? Well,
after I left Terra and my Brian Pearl, my partner, he used to also work in Terra, we kind of saw that, like Victor said, that the market was getting a little too hot. Of course, we could never predicted what just happened, but that's why we started looking into student housing, apartments, single home for rent communities, which we're doing in all the Southeast, because those are, we see and we feel that that's going to be what people will need in the next few years. How many $2 million apartments or condos can you build in Miami? The market is, there's still people there, but it's not what it used to be. So it definitely has accelerated our view. I mean, we never predicted, like you said.
Working on, I know that you said that you're working on a lot of single-family rentals.
Yeah.
And that is something that basically did not exist on a large scale prior to 2010, let's say. And
yeah. In 2008, there were some, a lot of the banks who had mortgages, but they were like buying homes in, they were very spotty. They were not communities. So what we want to do now is, and what we're doing now is single family home communities for rent. So between 200 to 300 units, and in places where there's a lot of job growth, where there's a lot of telecom ability, and where people want to live. So we're focusing in the Carolinas, in Nashville, Texas, DC. I think that's, in our view, that's going to be the future.
Yeah, and I agree with you, but I'm wondering if you think that the trend in those single-family rentals development, is that coming from maybe the new generation that doesn't necessarily like to own, and therefore they want to rent, but they don't want necessarily to rent a box in the South, in Brickell or somewhere in the Midtown. They want to have a place when they want to raise their family.
Yeah, I mean, that was our original thing, but also we're starting to get a lot of traction with the 50-year-old and plus, that they don't want to be tied to anything. And the same thing with the millennials. I have two millennial sons, and they can both afford a house, but they don't want to own one because they don't want to. They move a lot, so they don't want to know where, they don't want to be tied to something. But they want equality and the safety and high-speed internet and all the good things that you would get from an apartment building, let's say downtown Chicago. Versus if you live, but you have the ability to live in a house, your kid has a yard, your dog has a yard to walk, to run around.
I see. Interesting. Yes, that's an interesting trend. And to me, it's especially interesting because it just did not exist on large scale before the financial crisis. Then it exploded after that because large investors can buy them for 50 cents on a dollar or even cheaper than that. But now it looks like even if you develop them for fair prices, it's still an attractive investment.
No, and people will pay up for the luxury. Victor and I, when we were working in WCI, we did a very high-end condo project here in Miami, but the housing division that they were doing a lot of housing for sale, of course, on the West Coast, they did extremely well. I mean, their returns were higher than ours. I mean, I can never understand that because people will appreciate living in a house in a nice community with security and safety versus having to live in a condo building.
I see. Victor, maybe we should move to the next question. Do you see any of the long-term trends that you saw before? So, for example, co-living, co-working, online versus brick mortar retail. Do you see any of those trends that are accelerating, decelerating, or changing altogether because of the recent virus situation?
Sure. Again, the easy one is retail, right? I mean, that's the one that's getting beat up the most. I mean, I think everybody agrees that before COVID, we were probably on a 5-year downward spiraling of retail, and everybody was worried about the future of retail 5 to 10 years out. I think that 5 to 10 years has become 6 months, right? So it's gotten incredibly compressed into a very quickly downward spiral. And if you don't have pretty strong retail fundamentals today, I mean, you're either probably not going to reopen or, you're going to reopen to find out that you're going to have to close in the next 6 months to a year, right? So I think long term, retail is probably going to get hit the hardest, in my opinion. I think restaurants are here to stay. Of course, if you ask 10 people today what they miss the most about the last 2 months at home, they'll tell you it's going out and getting a meal, right? So I think restaurants are here to stay, so that's probably something that will have to change. Maybe more outdoor seats in the short term until we get a vaccine and we get this all figured out. Office is a big question mark, right? I mean, in my opinion, do I think people can work from home permanently? I think productivity decreases, right? But that's my opinion. So I don't know if that's a long-term effect that people are not going to want to rent office space because they think that their employees can work from home. I think, my opinion is that people are going to figure out that productivity is a little less. And maybe that's worth it to get the office, maybe it's not. So that's still kind of a question mark to me. I think hotels long-term will be fine. I think people will return back to hotels. Maybe look for more experimental kind of boutique type hotels instead of like the larger hotels where there's 1,000 people and convention business, right? So that's another question mark. When it comes to condominiums versus homes, I know that today there's a market that is trying to leave condominium living and go to live in homes because they're saying to themselves, if I need to get stuck for another 30 days, I prefer getting stuck in a home with a backyard than a condo where I have to deal with the elevator and everything. I don't know whether that's a long-term play or not. I mean, we'd have to see that. I read another interesting article on CNN this weekend about whether or not larger cities like New York, Miami are going to start to see a sort of movement to the suburbs again, based on what's going on. And the article is ambiguous, right? It doesn't really say what they think is going to happen, because I think in the short term people will want to leave, but in the long term they're going to want to come back. So a lot of question marks, Ellie. I wish I could answer with more certainty.
Okay. Anthony, maybe you tell us about your view a little bit more about what Victor talked about, but also what do you see in terms of trends with the co-living and co-working? Again, on one hand, you want to have, like you said, a little bit more space. On the other hand, some people, do not work in traditional offices, and then they have their own space in a place like a WeWork or any other kind of a shared environment. What is your view on those? Are those accelerating?
Yeah, I think the co-working model that we've seen over the last few years is dead. I don't see how the WeWork proffered, where you're essentially just buying resale wholesale and trying to market it out retail with these hot desks and cramming as many people as you can in, and your revenue streams are month to month, but you have this long-term liability on the underlying lease to the landlord. I think that model is going to be under significant pressure. However, where I do think there's an interesting opportunity on co-working is not so much on the one-off, entrepreneur that has one or two employees, or they're a gig economy worker. I think what will be interesting to think of is co-working for companies in the 10 to 50 employee range, right? Because that then allows a company to turn some of their fixed expense in terms of rent into a more variable expense. So if there is another situation where they need to lay off people, they have to work from home, what have you, their rent becomes much more of a variable expense rather than having a 5-year lease obligation on an office space that's been built out for them. So I think that might actually be where there's an interesting opportunity is, in these small to middle-sized type companies that want a real office, but you don't want the obligation with 5 or 10 employees. So I think that in co-living, I think, again, this will push, I think the folks that are having the locked off bedrooms versus the having your own individual bathroom, your own individual kitchen and living room, I think that there'll be pressure on those folks. But again, too early to tell. I mean, we're 8 weeks into something that's going to take a long time to shake out. I do believe, like Victor had mentioned, talking about the dynamic between, whether people are going to move suburban, urban. Again, I think too early to tell. But one thing I do feel very bullish about is I absolutely believe that when this all shakes out, Florida is going to again be a long-term winner vis-a-vis the Northeast. If our numbers stay low, our lockdown was less painful, our weather was amazing compared to what the Northeast underwent for the last 4 months. So I think this will just be, again, another reason when people think about where they want to build businesses. They have better taxes, better weather, more if there's a pandemic, it seems the pandemic is less of an issue down here. So I think that bodes well for Florida long term and medium term.
Interesting. Diego, what is your view mostly about maybe a movement from primary market to secondary, tertiary market, and movement from the city to the suburbs? Mm-hmm. And if I may add to that also, I mean, a lot of people talking about how a lot of manufacturing and technology that is currently being manufactured, processed, etc. in China is moving back in the United States. What kind of areas do you think will benefit from that the most?
Well, we are we're very bullish on the Southeast because of the taxes. The Carolinas, right now the Carolinas are the second largest tech location other than Palo Alto. So there's very high paying jobs. Alabama's got a huge car, Mercedes there, BMW's there. There's just very, very heavy amount of industry going in. Texas is of course a powerhouse. I may be a little biased since I'm a Longhorn, but my partner, he went to a Rise, but the amount of money going into Texas it's unreal. So I mean, you can see all the reports because of the taxes, like Anthony mentioned, and because of just the quality of living. You can have a nice house with a big lot and live really well and drive 10 minutes to your job versus living in a condo in upstate New York. So people are they're really starting to value that a lot.
I see.
So that's what we are putting that's what we're betting on.
Okay. Maybe I have two more questions before we wrap up and open it for people from the audience or virtual audience. In terms of showings, so maybe we can continue with you, Diego, and then ask Victor and Anthony. I'm assuming that some of the physical showings are not happening, and you're probably doing virtual showings. How is that
Zero.
going?
Yeah. No, everything is virtual. Everything is social media. We're lucky to have Landmark is doing all our marketing, and we're having huge success with that. But no, I mean, there are no showings, and all our projects are for rent. We don't have anything for sale product at the moment, which is great. We're very happy about that. So that industry is also going to change completely. How do you show a unit? It's not just the person and setting up the meeting, but if somebody's living in a unit, how are you going to vet that? People coming into your house, if you don't know who they are, it's going to be a learning curve, like Victor said, and Anthony said the same thing. We're just at the beginning of this thing. I cannot predict what the for sale product is going to be like.
But so far you don't see resistance from people viewing units,
No, I mean, we are doing apartments and student housing. And student housing, we have the best location next to FIU, so you kind of have to pretty much lease from us. So, and something interesting is that we have a very high percentage of one bedrooms, which are way more expensive than we have 2s and 3s. And the one bedrooms are being leased at the fastest rate. And people are starting to appreciate because we have one bedrooms with private bathroom, with private kitchen and everything. And I guess it's the parents, they rather pay another $300 a month than having a kid have to share a room with somebody else.
I see. Victor, what is your view on that? Showing virtually,
So,
how is that affecting your business?
Yeah, so our multifamily, which is Hollandale, actually has been fairly steady on renting units using virtual tours and everything. And again, that's a Class A multifamily, $2.15 type product. So that's been fairly steady. I mean, people that need to move, they need to move, and we show them the virtual, and if they like it, then they move forward. On the other hand, we have a 32-unit condominium project that's in pre-sale right now in Boca Raton. The units average $3 million, and we pretty much decided to shut down our sales and marketing efforts on that project because doing a virtual tour of a $3 million waterfront unit in Boca Raton is probably not going to work, right? So we decided any type of virtual presentation or wherever money we spent trying to set that up was not going to be worth it because nobody was really going to buy under those characteristics. So we just kind of shut it down. If we do have a buyer that's really interested in doing something now, and by the way, we haven't, we would try to show it to them, but that hasn't happened.
What you're saying is that there's a big difference between, showing a unit virtually to somebody who is committing for a year That's one thing versus somebody who is buying.
Yeah.
Actually, they buy a luxury product.
100%.
Huge. Yeah, huge difference. Yeah.
Yeah. Okay. That's very interesting, and it makes a lot of sense. What about and maybe I'll finish with you, Anthony, and then we can go to our questions from the audience. We're talking about, okay, we're just in the beginning, the early innings of that. I feel personally, I agree with you to some extent because yes, we are early, but we also need to remember that this situation happened very abruptly. It's not like any other recession that you start seeing the reports slowly coming in, a little bit worse. And, 3 weeks later, a month later, you see things are getting even worse. And then, 6 months later, okay, we're going to get into a recession. Just let's see how deep it will be, and eventually get into recession. In this case, basically, we had the economy, and people agree that within maybe a week or 2 weeks into, okay, we're closing our country for business, we know we're in a recession. So the downfall was a lot sharper. And because of that, a lot of people believe that the upswing will also be a lot sharper. In addition to that, before I let you respond, in addition to that, you also saw a much more swift response by the Federal Reserve, the banks, the government, and how they address solvency and liquidity. And in the recent recession, for example, it took much, much longer. So do you think that those are the kind of factors maybe make a difference between, getting deep into recession that is in the early innings that will last for a long time versus one that, okay, once we start opening up, it's a matter of, months until we are back in business?
I certainly think it's the latter, because there's been so much damage and trauma done to the economy and to the underlying social structure. I mean, you're seeing this even in Georgia, right? Restaurants are opening up and they're having 2 people show up because people are still afraid that they can get the disease. Even the most opportunistic plans have restaurants opening with 30% of their seats open, and maybe then we can go to 50%. Businesses don't work when you only have 30% of your tables open, right? So there's all of these things that are at play that haven't really never been done. Hotels, for example. When a hotel empties out and the bookings vacate, it takes a certain amount of time to restabilize a hotel, just like when you open a new hotel. So you have to rebook, you have to wait for it. So imagine, even if a hotel went from being closed today to 100% open, it's going to take months and months and months for it to even start to cash flow or to break even on its operational costs. And so you have a long period of losses still being incurred by the owners. What I'm trying to say through all that is, even if we were to open up at 100% tomorrow, which isn't going to happen, and even when we open up, it's going to be at a significantly reduced amount, there's going to be a lot of people that are unemployed because businesses aren't going to be hiring people back. There's a certain amount of folks that have been laid off that just aren't coming back, that the employers don't need them, the businesses have shrunk, et cetera. So, I'm concerned. I'm, definitely a proponent that we need to start the opening up sooner rather than later, because the longer this goes on, the more this temporary damage becomes permanent. So I'm definitely in the camp of, the risk profile for our world now, I think, has switched from the virology to the economy. And we need to start opening up with smart, sensible opening up plans, because, at the end of the day, I think it is going to be a long road to hoe, and that's how we're preparing. We're preparing for a long road ahead of us that can be full of opportunity, but I think it's going to be a slow, gradual recovery. It's not going to be this V-shaped recovery that I think is pretty much been dispelled at this point.
I see. Victor or Diego, do you want to give us maybe a little bit more optimistic? Only more optimistic. I agree with Anthony, but I would like to maybe finish with something a little bit more.
I know, like Anthony was saying, we're just seeing the tip of the iceberg right now, because what's coming is not going to be pretty. it's like you said, Ellie, when 2008 came, you could have sort of protect yourself and hedge a little bit, even though it was horrible. But this thing hit so fast that people were not prepared. But on the other hand, banks and the whole financial industry is very strong right now. So it's maybe hopefully the results and the effects of what's happening, the banks can take it and not go through what happened in 2008, which that was a whole other issue.
Yeah, Ellie, I probably agree with that. I mean, the banks throughout this cycle were a lot more disciplined in their lending tactics, right? So there's no real problem there. I think that there's a lot of money on the sidelines right now waiting for opportunities, right? So anything that hits real distress is probably going to get picked up really fast. And that's probably going to come more in the form of the debt markets getting a little distressed and notes trading and stuff like that. So that's, positive in that things may kind of flush themselves out quicker. And then, the other one that I heard recently that I think was something that Warren Buffett said, or Warren Buffett's partner or something, that, in the Great Depression, the problem with the jobs is that we didn't really know how to get people back to work, right? Like in this instance, we know how to get people back to work. We just need to figure out how to get rid of the virus, right? Because once that's gone, the restaurants will open up again, the retail will open up again in some capacity. The hotels will open up again, and most everybody can get back to work.
Okay, well, great. Well, Carlos, maybe you want to take from here and ask our panelists a few questions from the people from the audience.
Perfect. This is a question for all the panelists. How would you advise new developers to get started on business?
Anthony, you should take today you got to be patient. I would say that you probably need to start small, or join an experienced firm that you can learn from their mistakes, and with their investment. But I think investment in development right now is probably going to be a little slower. I mean, when you talk to private equity firms and stuff like that, everybody is geared to buying under replacement cost in today's market versus new development, which by definition is replacement cost. So I think that we need to figure out a lot of things over the next couple of months before we start going gangbuster again on new development projects.
Yeah.
Also for all panelists, how do you see the potential inflation affecting construction costs? Are you considering a slowdown in construction market that would translate into lower construction costs?
Not really. I think they're gonna go down because there's so much less construction. I mean, we're already seeing it. I don't know what you guys think.
I think in the short term we are going to see a decreased construction cost. I mean, we're estimating somewhere between 10 and 15% because of labor. I think in the long term, with the government printing as much money as they are, I think we are going to see some inflation. So whether or not that kind of picks up the savings that we're seeing, I don't know, but that's probably more of a long-term effect.
Okay, this is a question for Anthony. One of our attendees asked, how many projects will you work on Little Haiti? Will they be multifamily and or retail based?
Well, our project's a large master plan development that has all the different real estate asset classes in it. It has retail, office, multifamily, hotel. We're initially working on the first multifamily, which would be rental, and the first office tower. So those would be the first ones. We also have existing retail and office, but that's not high rise. It's the existing type of stock that was there that we've retrofitted, somewhat akin to what they've done at Wynwood. You know, we've taken these warehouses, we've added glass, AC, and we're putting, you know, creative office and creative users in it. So basically the full gamut, and we'll develop the actual buildings based on market conditions.
This is for all speakers. Based on the new norm, would you agree there will be a downturn lease of office space? Do you foresee a decline in office spaces?
Yeah, like I think we've said, office still has a pretty big question mark, because, you know, whether or not people get really comfortable with working at home is something that's going to be answered probably in the next couple of months. But I do see a decrease in the demand for office space in the short to medium term.
No, I agree. 100%.
This is a more intense question. What are some of the preventative measures, both practical and technical analysis and judgment, will you incorporate into your firms in order to cope with any future crisis?
Carlos, I think you're cutting off.
Did I cut off?
Yes.
Sorry. Can you hear me now?
Yes, now we can hear you.
Let me repeat myself then. What are some of the preventative measures, both practical and technical analysis in judgment, will you incorporate into your firms in order to cope with any future crisis?
I'll take a first shot at that. Our macro view is that each individual deal is somewhat different, but if we're going to talk about large scale development, we approach it a little more conservatively, because what debt does is debt reduces your margin of error. So the higher debt you have on a project, the less mistakes or the less changes to the market conditions you can tolerate. So if you have it also, however, it negatively impacts your equity return. And so it's very important that you balance that. But as our firm typically looks at it is we would rather leave a little bit of money, equity return on the table to have a higher certainty of success and not running into some either economic problem or some project specific problem that really wouldn't have been a problem if we didn't have such high levered debt. And that typically manifests itself through the use of mezzanine or preferred equity or things that take you higher than a traditional first mortgage would.
Another question we have, how do you see property insurance policies and premium adjust during this pandemic?
I'll take this. We just went through our insurance review and update on our project, and it was actually pretty stunning. And I've seen this on a rental property I have down Miami Beach as well. The general liability and property rates in South Florida, at least in my experience over the last couple of months, have skyrocketed. And that's because what we've seen is on the reinsurer base, the companies that insure the insurance companies have significantly curtailed their allotments to South Florida because of exposures they've had around the world. And so, for example, on our project, we just experienced a 30% increase. And on this rental house I have just on a personal basis, it went up 25%. There's been no losses. There's been no reason. We haven't had a hurricane, that's done significant impact, at least here in Miami last year. So, it's all being impacted by these reinsurers, but it's been significant. Wow. My question is, what is our county government going to do on the real estate taxes? How are they going to address 2020?
Well, if we have the government to be still,
Well,
you get
since they have no income from, at least in Florida, since they have no income from, hospitality and all that, I don't see them going down on real estate
Right.
prices.
And sorry, Anthony, do you ask, is the reinsurance business suffering mostly because of the business interruption insurance, or why is that?
Well, it's not. Well, the reinsurers look at this on a global basis. So even though we might have, it has nothing to do with COVID. This was pre-COVID that these prices were starting to kick in.
Oh, really?
Yeah. So you're seeing, it's named the crisis, but on a global basis, there's been some reallocation to South Florida. So for us, I've seen it at every level of property that I've involved with, significant raises between 25 and 40%.
Right.
On liability.
But this is just South Florida, right?
What's that?
This is just South Florida, right?
That's I don't have any exposure anywhere else, so I don't know. But
Yeah, because we haven't seen it much in the Carolinas or in Texas.
maybe it's just South Florida then.
Oh. Okay.
This is a question for Victor. How are you analyzing investment opportunities moving forward, given the fact that historical revenues have been wiped out?
I'm sorry, given the fact that what?
Historical revenues have been wiped out.
Okay, so we don't really look at hotels that much, and we're looking at very little retail, if any at all. If we look at any retail right now, it's probably because it's a redevelopment play, and we're probably bringing the retail revenues down to zero anyway at some point before we can redevelop, and sort of like a covered land play. I think honestly the two biggest asset classes that we're looking at right now is land, because we think that the owners of land that have leveraged up with maybe some private money are going to get themselves in a situation where they need to sell. And the one I was talking about before, which is a covered land play, which is, maybe a retail shopping center that 50% of its tenants are gone or 75% of its tenants are gone, and we can buy it, still get a little bit of cash flow from the existing retail tenants, wind it down, re-entitle it, and then redevelop it as multifamily. So, those are probably the two biggest asset classes that we're looking at now, and one doesn't really have any revenue, and the other one is pretty much of a wind down process. So.
Next question is, what do you think about your current tenants? Do you think about how the tenant selections will be moving forward after this pandemic?
Anthony?
When they pay their rent.
Essential versus non-essential.
Listen, I think it may be one of those certain beggars can't be choosers. I hope we're in a situation where we can be picky with our tenants. We've been fortunate that, we've only lost one tenant. There was a very, very small startup that was relatively inconsequential. But we certainly prioritize the tenant's ability to pay, because at the end of the day, the brain damage of getting that tenant going through a lease negotiation, doing tenant improvements, all of that stuff, the last thing you want is for somebody to go dark. And so our number one consideration at this point is going to be their ability to pay going forward. And does their business plan allow, do they have sponsorship that has money that they could put in to pay rent if they need to, and is their business going to be viable in this new normal?
Yeah, I mean, the only retail that we have is the Aventura Park Square one, which is, it's pretty significant. It's 50,000 square feet. And like I said, it's mainly composed of restaurants and fitness, which are hurting right now pretty bad because they're not collecting any revenue. I got an email from one of my retail brokers, I think it was, a couple of days ago, asking me if we had any fallout because he had somebody who was interested in retail space, and my reply was really question mark, question mark. So I think I think right now, you know, it's hard to be choosy, but if we're going to spend dollars on TIs and everything that we need to do to get a retail space ready, we probably want to make sure that it's somebody that can pay rent long term.
And our last
How do you
question.
do that? Is that credit, or is just by, you know, getting a high deposit from them, or?
It's probably a combination of all that. I mean, you know, credit, financials, larger deposit, you know, of course, mixing into that the fact that we're in this situation and we can't really be that choosy. So it's good. Look, that process is going to be interesting, right? I mean, you know, in one way you want to collect rent as quickly as possible in that space, and there's not a lot of retailers to choose from. But in another one, you don't want to go spend, you know, a couple $100,000 on TIs to get somebody in there that you think is going to pay rent, and then 6 months later is going to be asking you for concessions or is going to bail. So it's going to be really interesting.
Okay.
Okay, since we're nearing the end of our event, I'm going to ask the last question, and I hope that all of our panelists are able to answer it. Are there any foreseeable permanent changes in the real estate market, residential or even commercial?
If I knew that would be great.
Permanent for a long time.
I think telecom is going to be a big thing coming up. I did a lot of telecom business in the early 2000s. And because of all this, you know, offsite office space and all that, telecom is going to be a big thing.
Are you referring specifically to antennas and?
No, like data centers, the ability to provide very high speed internet so we can have conversations like this. That's not going to go away.
Yeah, I mean, we didn't really touch on that, but when you said telecom, it kind of, you know, got my
attention. I mean, I'm talking about data centers.
Data centers and antennas real estate. It's not pure real estate. We all know that, but they're the one that faring the best. You see any?
Yeah, no, and for real estate, it's great because, you know, once you have a tenant, they usually stay there for, they want to do 30-year leases.
Yeah. Anybody else on that?
I mean, it's difficult to call any permanent changes right now, Ellie. I mean, I mean anything that I can think of that I know is going to be impactful in the short and medium term, I can't tell you with any real confidence is going to be there in the long term, because I think ultimately people have short memories, and you know, things may get back to normal once a vaccine is out and nobody has to worry about COVID anymore. So it's hard to call any real permanent changes right now.
Okay. So let me wrap this discussion with just one last question. I'll let each one of you answer really with 2 words. And that is, you know, where do you see cap rates going, general cap rates going up or down over the next year and over the next 5 years? Victor.
So I think you will see some expansion in cap rates. I don't think it'll be significant. You know, the easy one is multifamily, right? I mean, before all of this, you'd find deals happening in the, you know, 4.25, 4.5 type cap rates for, you know, stabilized Class A multifamily type space. You know, do I think people are buying in those type of cap rates today? No, because there's some uncertainty in the short and medium term. How much do you have to give them in order for people to start transacting right now? I mean, you know, if I had to guess, if you show somebody a you know, Class A multifamily in the 5 to 5.25, which is, you know, almost a whole point spread, then, you know, I think people will transact there because they know that this shall pass in the 5-year term that you're talking about, and their multifamily project will probably get back to normal, and they could probably still get some decent financing in today's market. So I think in the 1 year, I think that we will start to see some spreads, whether it's, 50 basis points, 100 basis points, or 150 basis points. I'm still not sure, but I think that gets back to normal in the 5-year term. Of course, you've got a lot more variables in the 5-year term, right? What happens with all the money that the government is pumping into the system and all that. So, not sure.
Okay, that was more than 2 words, but thank you. Diego? 1 year?
Yeah, I know. I agree with Victor. It's very hard to predict things. On Friday we had 21 million lost jobs, and the market went up 300 points. So I'm confused,
The market
like everybody else.
That's the whole argument.
I agree that, and there's a lot of money parked on the sidelines to invest. So obviously, I think the market caps will probably go higher in the short term, but then they'll go down on the long term again, because people want to invest in real things. There's a lot of investment on mortgages. Fortress just spent $500 million 2 weeks ago buying paper.
Yeah.
So it's starting. But like Anthony said also, it's so hard to predict. We have not seen it's very hard to see the whole picture.
Okay.
Yep.
Anthony, short term, long term, cap rates.
Short term, they go up. Long term, they go down. They have to go down because people continue to chase yield and risk. The government has to keep government rated debt low. Otherwise, we go bankrupt. So.
Okay, so we do have a consensus in the short term. We'll have some expansion, and then it's going to go back to where we are, to maybe even lower, especially with interest rates as low as they are right now. So, well, I guess it's 12:30, and we do have to respect your time. Thank you so much for joining us. I really appreciate your time. We had, at the height I saw here, we had almost 200 people listening to us, and I know this will be recorded, so we're gonna send it to the other people that sign in and could not join us live. So once again, thank you all for your time. We really appreciate it, and hopefully we'll see you in person before too long. Bye.
Thanks, Ellie. Look forward to it.
Thank you. Pleasure.
Bye.